We've got Toby Janson-Smith, Chief Program Development and Innovation Officer at Verra. So Verra is one of the most influential players in voluntary carbon markets. We're going to hear what they're doing. And then right after, we're going to have a discussion with Regen Network about the Amazon headwaters and the development of biocultural jaguar credits. Should be a nice back-to-back complementary discussion. So please stay tuned. And with no further ado, Toby, the floor is yours.
Thank you. Great to be here. Thanks for coming. I know it's an action-packed week in the city, so I know you got to spread yourselves sometimes thin, so we appreciate you showing up to this one. So yeah, I've been asked to speak a little bit about what we see, or I see. Oh, sorry. I should probably not do that. Does someone know how to get that slide back up? So anyway, I think, do you guys want the main slide up there? Well, I don't have slides, so you can maybe just go back to that. Yeah, I just hit the wrong with my phone. So yeah, what I wanted to talk a little bit about is what we see as the key enablers for scaling the voluntary carbon market, so we can unlock a massively larger amount of investment for climate action. And then along the way, I'll talk a little bit about some of the work and related initiatives that Verra is doing to help support that scaling. So where to begin? I think, for me at least, it's helpful to break the problem down in some different categories. So when I think of scaling, I think of scaling demand. It's job one. If you don't have demand, you're not going to get anywhere. Scaling supply is equally critical, and I'll unpack that a bit. How can we link, how can we establish linkages between the VCM, voluntary carbon market, and compliance markets is going to be critical increasingly as we go forward. And alignment for the Paris Agreement and other regulatory systems. And then finally, how do we build the enabling technology and infrastructure to support that kind of scaling to get to 100x really of what we are now. And you heard some great remarks earlier, and I think earlier today, and probably in other sessions of what's going on in terms of the technology and the infrastructure side that's really helping to enable and make those things happen and scale. So anyway, that's kind of going to be the four buckets that I cover. And just to start off, I think there's a widespread recognition that carbon markets, and in particular in the near term, the voluntary carbon market, or the VCM, has to play a critical role and be massively scaled if we're to stand a chance of creating a 1.5 degree future. And there's more and more evidence around that, and I think momentum and appetite to get us from the few $1 billion currently transacted in the market now in the VCM up to 100 billion plus, or at least 50 billion in the next decade plus. So that's what we need to get to, but a lot of work needs to happen, obviously, to get there. And if we think about the demand side as being job one, how do you get corporates and other investors to start to engage with this space and put money on the table, start to support projects, drive emission reductions and removals? We have to figure out a compelling value proposition and use case for carbon credits. And I'd say in the last few years, that's been, a bit of a moving target, let's say. And there's some important initiatives that contribute to helping give comfort to corporates in the use case and how they can credibly use carbon credits and offsets. One of the big initiatives, of course, around this is the Science-Based Targets Initiative, SBTI, that is basically setting the standard for net zero, how corporates can get to their contribution to a 1.5 degree future through a net zero construct, and to think about the road to net zero and what that looks like. And then also beyond value chain mitigation. So what are the activities that companies can embark on outside of their value chains to support climate action? So that's one key initiative. I'll talk a bit about that. And then another one on the demand side is the VCMI, the voluntary carbon market initiative. And that's more about claims. And they have out for consultation right now one of their claims models around Scope 3 flexibility claims that I'd encourage many of you who are interested to weigh in on that. It's an important consultation, and we need to get that right to build not just confidence, but more consistency in the claims so things add up. But back to SBTI, one of the big opportunities we see there is, they've done great work in setting kind of the carbon budget and what companies need to do by sector for their contribution. But whereas a bit lacking right now, it still needs work, is really two things, I think. One is, what's the journey to net zero? What do companies need to do along that journey, and how can they get recognition for that? And until they get recognition, it's going to be very hard to incentivize some of those activities. So I think that's still a gap. And then secondly, as I think you heard from, I think it was Marcus earlier, talking a bit about removals and reductions and the bathtub analogy. That's a critical piece of the equation, is to make sure that we are not shortchanging emission reductions. And, for better or worse, a lot of corporates have interpreted the SBTi's guidance about net zero, which basically is, reduce your corporate emissions in your value chain, scope 1, 2, and 3, up to, on average about 80%, depending on the sector. And then beyond that, you mitigate to get to zero using high quality carbon removal or CDR credits. That has kind of had the effect of a lot of corporates and buyers, investors thinking that only removals and CDR are really a credible emission reduction, a climate change mitigation source or a credit source. And that actually is not the case. I was talking to SBTi leadership just yesterday, and they were assuring us that no, that's not the case. They've been kind of silent on reductions and removals on the journey to net zero. And we made the point that needs to be clarified. So for those of you out there, whether you're corporates or you work in these networks, please don't give up on reductions. It's absolutely critical. Yes, we need to invest in CDR. It's capital intensive. We need to bring the cost down and scale that up. But it's not going to provide anywhere near the kind of scale of cost-effective mitigation that we need anytime soon, as I think Marcus pointed out, with their relative orders of magnitude difference in the portfolio of credit flow they're seeing. So emission reductions are critical for solving climate crisis, and they're critical because in many spaces, let's say ecosystem conservation, whether it's RED, reduced emissions from deforestation and forest degradation, or mangrove conservation or grasslands conservation, those ecosystem conservation projects that can generate significant emission reductions, they're really use it or lose it. So if you don't protect those forests, and we're losing still, 10 million hectares a year, a really tragic situation has really continued unabated, and there's no finance or incentive to stop that. Carbon finance is one of the only ways we will do it. If we cut that off and don't scale it massively, we're going to lose all those ecosystems and their carbon potential. It's going to be up in the atmosphere, and then at best case, you start to replant those lost forests. But it's use it or lose it. And you lose all the biodiversity, indigenous lands, livelihoods, etc. So that's something I just want to make sure that people get, and hopefully SBTi will better communicate that reduction's absolutely critical as well as removals. VCMI I mentioned, they've got a Scope 3 flexibility claim out for consultation that starts to put in place how do carbon credits or flexible mechanisms fit into the broader leadership that companies might engage with to reduce emissions in their own value chains. And it's a contentious topic, the role of offsets and other credits, or what percentage and how linked to the supply chains, like insets, do they need to be credible? So again, please weigh in on that consultation if you have a view. Verra really recognizes that we're big into carbon credits. We account for about half of all the world's carbon credits that are issued. So we get and live and breathe in that world. But we also recognize that eventually about 80% of the mitigation needs to come from value chain, scope 1, 2, and 3. And we want to play a role to support and facilitate and scale that. And so we've been working the last couple of years to develop a Scope 3 standard and program that we're linking and working with SustainCert and other leaders to bring over the existing momentum from corporates on the Value Change Initiative and other efforts into using this standard, which will be built on the VCS methodologies. So we can jumpstart it that way. So the carbon accounting is very robust, but it will allow corporates to start to account for their inventory reductions in their supply chains, and do it in a robust way and in a flexible way, where there's no traceability, for example. How do you actually credit and assign responsibility or ownership to a particular credit and claim in the value chain? And that's a big piece of that work too, that it will really have a big difference. And I heard just this morning at a meeting there that there's $1 billion sitting right now that could be unlocked in value chain investments if we had a standard like that we're developing. And that'll be launched, the first version, the end of next year. So be on the lookout for that. So the point is, it's not either or. We're not talking about carbon credits and offsets displacing corporate action in any way, shape, or form. Job one is absolutely corporate action in the scopes 1, 2, and 3. But that's not going to get us all the way there. And in parallel to that, we need to massively invest in carbon credit projects, especially in sectors that otherwise won't be tackled. And nature-based solutions is obviously a big area. Some of the CDR obviously is big in that too. So that's on the demand side. The other piece related to demand is trust. And as we all know, or those who have tracked it this last year or two, have been pretty rough for carbon markets with some of the press. Some stories, based on reasonable evidence, some not so much. But the fact is, quality needs to improve, and we need more assurance at the highest levels of what is a quality credit to bring back confidence to these corporates and buyers and investors. And ICVCM, the Integrity Council of the Voluntary Carbon Market, is playing a key role there. They have the Core Carbon Principles, which is a framework that basically assesses through these multi-stakeholder groups, expert groups, that assess the various methodologies from standard setters like Verra and the VCS, Gold Standard, CAR and ACR, for example, assess the methodologies by sector, and then determine if they meet their standards of high quality and integrity. And if they do, then the credits from those meths can earn a CCP label. And that's the kind of thing, when it gets more momentum, or actually they have more sectors approved, is going to be key to build confidence and comparability across the different standards bodies. So that's going well. Only a small number of credits and sectors have been covered so far, but we're cautiously optimistic that the last quarter of the year we'll see some key sectors move forward. Maybe Red Plus would be a great one, cook stoves, and some other key sectors that need that seal of approval, if you will. So that's a little bit on demand. Scaling high quality credit supply, that's the next piece of the equation. So if you have a lot of demand and not much supply, the supply, of course, is in the projects. They generate the emission reductions and removals. So that's the climate action that we need. And so, it's where the boots hit the or the rubber meets the road. And what's going to be critical there is to unlock new sectors and be able to scale existing sectors and activities. So we're working really hard on that piece. The work I lead with my Department of Program Development and Innovation is very much around not just how do we develop programs like the VCS or Scope 3 program, et cetera, but also how do we develop and work with partners to develop methodologies that are best in class, that start to tackle new sectors, bring in new accounting regimes. We'll talk a little bit about that in a minute. But sectorally, a couple of highlights to mention to watch out for. Energy and industrial, a lot of opportunities there. We're working on a carbon capture and storage plus framework with all the big players, over 100 participants in the CCS Plus initiative. That's basically will cover all the major activities under CCS, so DACS, Direct Air Capture, BECS, Bioenergy Carbon Capture and Storage, traditional industrial source capture and storage, aquifers, and other reservoirs. So that work is about halfway through in terms of those methodologies and modules being released, and we'll start to generate, we think, some good activity and investment. RED, reduced emissions from deforestation and forest degradation, kind of an area that is difficult, huge, as I said, global problem, not easy to account for, but essential that we do, and we bring carbon finance to those projects. And Verra has moved, in the last 2 years, we've been shifting from a project-based approach of baseline setting, which is one of the biggest challenges, is to a jurisdictional approach where basically we use global data sets from the leading scientific bodies and academic institutions to define or agree on baselines at country or state levels around the world and global south, and then basically use different models that then can allocate those baselines based on risk down to the project level. So instead of it being defined bottom up by the projects, which is challenging and inconsistent and doesn't always add up, this new approach will bring consistency in a top-down way that adds up with all the jurisdictional baselines, which is going to be important for government action and transparency. And it also just sets upfront what the baseline is. So the proponents, the investors, and buyers know what they're dealing with from the get-go. So that's the data is being worked right now, will be allocated in the next 2 months for the main jurisdictions or the first wave. And then we'll start to see those projects that have been waiting for that methodology to move through with RED. And we hope that will earn CCP labels under the ICVCM, will be the first of its kind methodology. And that will drive, we hope, a lot more momentum and demand back to RED, which has been kind of stalled out, I would say, for the last year, really. Afforestation, reforestation, and improved forest management. Key areas, a lot of sequestration potential for CDR. And we have developed dynamic baseline approaches, a different way of setting up control sites for baselines that's very data-centric and very promising in terms of what it can do in terms of integrity and scale. On the land-based as well, agricultural land management, we have a new methodology, VM42, that really covers all the range of agricultural practices from soil carbon sequestration to precise nitrogen inputs to water management and all sorts of other areas. And that methodology already has 150 projects in the pipeline. So that's shaping up to be one of the really big emerging sources of credits and supply. Again, we're optimistic that will earn CCP labeling as well. And then a few other areas. Blue carbon is a critical one. Mangroves, seaweed ecosystems, et cetera. Conservation, restoration, avoided bottom trawling. We're working with National Geographic and some other leading scientists to think of how you could bring the concept of RED to the oceans. So avoid bottom trawling, destroying the ecosystem and habitat. Fish nurseries, and by doing that, you also prevent the disturbance of the carbon through to the aqueous and then the atmosphere. So there's a lot of potential there. Could be super useful and scalable. Food loss and waste, and climate-friendly diets. We're doing a lot of work there. We have a methodology in the works there that recognizes, of course, plant-based or plant-forward diets. Have huge potential to reduce emissions. And so that's in the works. And then finally, cook stoves. We're redoing all our cook stoves methodologies, like all the standards bodies really to date have relied on a clean development mechanism, UN CDM that is okay, but it's a bit dated now, and there's better methods and factors to incorporate based on the latest science and thinking. So we're releasing later this year a brand new cook stoves methodology that we also would expect would be CCP labeled, and will rebuild confidence in that sector that took a lot of hits as well. So that's a bit about the sectors. New approaches. What do we need? We need innovative ways to think about some of the challenges of carbon crediting and the projects and how things are accounted for. We're working on permanence as an example. We're launching now a long-term monitoring system where we can use data, remotely sensed data, to detect reversals and losses and automatically adjust what's held in the buffer or other accounting adjustments rather than just relying on paper or the projects to tell us. We're also been in a lot of discussions with insurance companies and thinking about, could insurance take over some or all of the permanence risk that's currently managed in the buffer? That would release a whole portion of credits, on average maybe 20% that sits in the buffer. So it could be used, recycled, in terms of the capital. And insurers, of course, can do a great job of identifying and pricing risk. And the transparency around that could be really beneficial. So that's something we're also leaning into. And then finally, what you heard about in the previous panel, DMRV, digital monitoring, reporting, and verification. So that's the idea of moving away from paper-based, human-based assessments and verifications, and starting to basically rely on sensors, remote sensing information, AI, and other algorithms to start to be able to populate as many of the inputs into the carbon accounting as possible to reduce human assessment error and time and increase transparency. So we have a bunch of pilots there running through the end of this year that we hope to issue some of our first DMRV credits at the beginning of next year or even before. And I think that'll be a really important paradigm to kind of put out there. So that's a little bit about some of the new approaches that we're working on. How much more time do I have? Okay. So let me just go then whip through the last ones. So linkages with compliance systems. It's great to see U.S. Treasury Department statement supporting the VCM. It's nice to see more and more governments start to link to VCM standards and credits. So we have VCS credits are eligible in countries like Colombia, South Africa, Chile for their domestic ETSs. There's more of that happening. And then Article 6 under the Paris Agreement is going to be a really important opportunity for bringing together the VCM or carbon credits, current carbon standards with government commitments and nationally determined contributions. And we're working with, for example, the government of and entities in Philippines on an early retirement of coal-fired power plants to generate credits that the government of Singapore is interested in as an Article 6 transaction. So those worlds are coming together and they need to. And then I'll just finally end on enabling technology and infrastructure and financial innovation. You've heard from a lot more smarter people than me today about what that looks like, but it's pretty amazing what's going on in terms of the registries, blockchain tokenization, what we can do there, what can be done, the potential to pre-finance projects with new tokens linked to smart contracts so you can get early finance for some of these forest restoration or CDR projects that automatically convert into carbon credits as they get verified. There's collateralization of credits, price discovery that we can start to see on these large aggregated registries and sort of blockchain native approaches. And then things like pooled assets and portfolio approaches are going to be key too as we start to scale up, and the infrastructure enables that. And I think that will take away a lot of the risk that is keeping some of the investors on the margin. So it's a really amazing time for innovation and opportunity. We all need to make sure some of the macro indicators, SBTI, some of these other macro standards bodies, ICVCM, et cetera, accelerate their work, send the right signals, be clear about it to corporates and to other players in the market. And then we as standard setters need to do our job in terms of the standards programs, the methodology development, to build confidence and integrity there, but also scale from the different sectors. And then finally, make sure that the enabling infrastructure and technology is there to support all this and really take it to the next level. So that's really in a nutshell, my view of where we're at and where we need to get to. But it's an exciting time for sure.
Great. Round of applause for Toby. I'm going to take one question for Toby and the Verra team. Question from the crowd? What's moving with Verra? Yes, right over here.
I'll make it a simple question. It may have a complex answer, but given the downturn in the market, the VCM, over the past year or so, what's your prognosis for 2025?
Thank you. Yeah, great question. Our sense is that 2025 is probably going to be fairly soft as well. We're seeing more buyers come in, and I think the ICVCM is going to build some more confidence and coverage for corporates and investors that want to re-engage and scale up. So we're seeing positive signals there. We think the technology side is helping. We know that many corporates, especially tech companies, are starting to increase investment with some of these new platforms, DMRV and other partnerships they've got going. So I think that basically the building blocks and the foundation is being built, and that's really encouraging. But that will be built and sort of solidified, I'd say, in 2025. And then we're hopeful, end of 2025 and beyond, we start to see a real uptick and start to see the scale that we need.